you do when the breakup happens. And then you need to choose which of the newly created companies you want to hang on to. And isn't that the dilemma right now with longtime Kramer fave Abbott Labs, ABT for you home gamers? Abbott used to be a big, diversified healthcare company, although I always saw it as a fast-growing medical products company that was being held back by its slower growth pharmaceutical business. That's why I was delighted back in October of 2011 when Abbott Labs announced it was going to split itself into two separate companies. The pharma division would be spun off as a company called Abbvie, symbol ABBV, and then the stub of Abbott Labs would keep the faster-growing divisions like diagnostics, nutritionals, generic drugs, and medical devices. I thought this was a terrific plan, so I recommended the stock in November of 2011. It's been sticking with it ever since, and over the next 13 months, in the lead-up to the spinoff, Abbott Labs gave you a healthy 24% return. Then on New Year's Eve, when everybody else was out celebrating, believe me, I was one of them, Abbott completed its corporate divorce, where before there was one company. Now we have two. Abbvie, the slow-growth pharma play with a bountiful 4.7% yield. And then the new Abbott Labs, faster growing with a much smaller dividend, one that yields only 1.7%. Ever since that split up, I've been inundated on Twitter at Jim Kramer with people who want to crush me for what I said about Apple and are also asking what to do about Abbott. Historically, when you see this kind of breakup in the healthcare sector, the newly spun-off company tends to outperform the parent dramatically over the next year, and even more so over the next 2 years. In other words, ordinarily in a situation, the stock to buy would be Abbvie. But this is no ordinary spin-off. That's why I'm telling you to stick with Abbott Labs. Not only that, but I like it so much that my charitable trust, which you can follow along at actionalertsplus.com, is sticking with Abbott too. And I gotta tell you, I'm excited about it. I think it's going to be another big winner. The reason? Oh, the whole point of this spinoff was to free Abbott Labs from the shackles of its tortoise-like pharma business. Now they've done that. Abbott's true growth potential can at last be unlocked. And make no mistake, the new Abbott Labs is in an excellent position to grow revenues far faster than its peers. The company is now a diversified global medical products business with 4 key segments. You got nutritionals, medical devices, diagnostics, and established pharma products, the latter meaning generic drugs. The nutritional biz is the largest component, and it should expand at a rapid 35% compound annual growth rate over the next 3 years. That's stellar. Plus, even though it's growing very fast, Abbott's nutritional segment still has a ton of room to expand its margins, which are about 500 basis points below the industry average. Diagnostics, we love diagnostics, so it's another fast-growing area that we like it because it's a major component to helping to contain healthcare costs. Abbott's got some room for margin expansion here, too. Now, the reason Abbott can grow so quickly is because the company gets 40% of its revenues from another theme that we're enjoying in 2013, emerging markets, especially super fast-growing countries like India and China. And in the next few years, that could go to 50%. Its peers, on average, only get about 10 to 20% of their sales from emerging markets. Abbott is the healthcare way to play emerging markets. But just as important, Abbott Labs is retaining the great Miles White. Oh, man! As its CEO. White is one of the best execs in the healthcare industry. I hope he comes on Mad Money. He's the guy who masterminded the breakup, and he's done a terrific job of running the company. If he had decided to go with Abbvie instead, wow, I would have seriously considered swapping out Abbott and into Abbvie. Yeah, he's that good. I think Abbott's guidance for 2013 is conservative and very beatable. In part because White is so good at controlling costs. Abbott's forecast is for margins to expand by 200 to 400 basis points. I think they could potentially do better than that. And for every 100 basis points of margin upside, Abbott's earnings per share increased by 15 cents. So you can only figure, you hear that better than expected. What's going to happen? They're going to report, you hear better than expected, and then you're going to be able to say, well, it's the gross margins. Plus, Abbott has a healthy balance sheet, and it should generate $3.1 billion in free cash flow this year. That means the company still has a lot of flexibility to return capital to shareholders, either through a higher dividend, more likely a buyback, or they can make some smart acquisitions. And now they're area where I trust Miles White to get it right. Now, the old Abbott Labs sold for 12 times forward earnings with a 9% long-term growth rate. The new Abbott currently sells for 17 times forward earnings, but has a higher growth rate in low teens, so market players will pay more for that higher growth rate. This is what's called multiple expansion. I predicted we'd see that after the breakup, but it might not be done. I can see the stock going to 38, which is 13.4% above where it is right now, simply on the strength of this revaluation from the spinoff. That's why I like Abbott Labs. Well, now, what about the Abbvie, Abbott's old pharma division? Okay, juicy yield, 4.7%, I think the stock's not as good as Abbott for the simple reasons that there's not a very exciting growth path and there's nothing big in the pipeline that would fuel much growth down the road in the so-called out years. Sure, Abbvie's got good management, along with it's got a global footprint that's good, and a decent portfolio of drugs with a relatively stable sales, but a single drug, Humira for rheumatoid arthritis, this is what's the problem. It accounts for 40% of Abbvie's sales. And that drug could start facing generic competition as early as 2017, and the market's going to start thinking about that well in advance, even though it's 4 years down the road. And that is a huge patent cliff. And we don't know whether Abbvie has got anything in the pipeline that's big enough to replace Humira. They're working on a drug for Hep C, but there's a lot of competition in that space right now. Gilead seems to be in the lead. At the end of the day, Abbvie sells for 11 times forward earnings estimates, about the same valuation as Pfizer, even as Pfizer has, I think, better prospects. Here's the bottom line. Whenever a company you like breaks up, you need to decide which component to keep owning. With Abbott, the answer is easy. The whole point of this spinoff was to get rid of the no-growth pharma business that was holding the rest of the company back. So forget about the pharma business. Abbvie, no. And stick with Abbott, yes, which I think can actually be bought. I rarely ever say this. Don't need a pullback. I buy it right here. After the break, I'll try to make more money.
Coming up, gas guzzler. America's overwhelming supply of natural gas has cooled off the price of